Hello everyone. In this video, you're going to see how to prepare a consolidated balance sheet between H Limited and S Limited. So the problem says that H Limited acquired 40,000 equity shares of S Limited on 1st January 2015. So out of the total number of shares of S Limited, if you look from the balance sheet, which is 5 lakhs, so the number of shares that they have is 50,000. So out of 50,000 shares of S Limited, 40,000 shares has been acquired by H Limited on 1st January 2015. Then we have to prepare a consolidated balance sheet as at 31st December 2015. So in preparation of a consolidated balance sheet, before doing that, we have to do the various working notes. So now let us look at the various working notes. Now the first working note is the degree of control. So we know that the total number of shares of S Limited is 50,000 shares. Then the shares held by H Limited is 40,000 shares. So the minority shareholders shares will be 50,000 minus 40,000, so 10,000 shares. So the degree of proportionate holding between H Limited and the minority holders will be 40,000 shares is to 10,000 shares, which will come in the ratio of 4 is to 1. Then the second working will be the control chart A. So under the control chart A, first of all, we have to find out the pre-acquisition profit, and it has to be distributed between the H Limited and the minority holders, or between the holding company and the subsidiary company in the ratio of 4 is to 1. So in the pre-acquisition profit or capital profit, we have to take the profit and loss account and the general reserve as on the date of acquisition. So we know that the date of acquisition is 1/1/2015. Then we have to take the profit and loss account and the general reserve as on that date. Now if you look at the problem, you can see that the general reserve on 1/1/2015 of S Limited is rupees 1 lakh, and the profit and loss account balance on 1/1/2015 is rupees 30,000. So these two will be the capital profit or the pre-acquisition profit. So the total pre-acquisition profit will be 1,30,000, and this 1,30,000 has to be shared between H Limited and minority holders in the ratio of 4 to 1. So H Limited will get 1,04,000 and the minority holders will get 26,000. Then the second thing that we have to do here is the post acquisition profit or the revenue profit. So under the post acquisition profit or the revenue profit, we have to take the profit and loss account and the general reserve during the year. Now, if you look from the problem, the post-acquisition profit in this case will be only the profit for the year 2015, which is rupees 40,000, and this 40,000 will have to be shared between the H Limited and the minority holders. Now we can see then the post acquisition profit or the revenue profit. So profit for the year 2015 is 40,000, and this 40,000 will have to be shared between the H Limited and minority holders in the ratio of 4 to 1, in which H Limited get 32,000 and minority holders will get 8,000. Then the third one will be the share capital. So under the share capital, you have to take the share capital of S Limited in total, that is 5 lakhs. Then you have to less the minority holders shares. So remember, out of this 5 lakhs, 10,000 shares has been held by the minority holders. So 10,000 into the face value of rupees 10 will get rupees 1 lakh, and this will be showed in the minority holders column. Then the remaining balance of the share capital belongs to the holding company, which will be adjusted in control chart B for rupees 4 lakhs. Then in this control chart A, you have to get a total of the minority interest, which will be rupees 1,34,000. So now after the control chart A, we have to prepare the control chart B. So in the control chart B, it started with the cost of investment held. So remember, this cost of investment held you will find from the asset side of the balance sheet. So you'll find it from here, that is non-current investment, the amount of investment made by the holding company in the subsidiary company. So here they have taken 40,000 equity shares in S Limited for rupees 5 lakhs. So the cost of investment held is rupees 5 lakhs. Then you have to less the face value of shares held. So we know that the holding company has purchased 40,000 shares at the rate of where the face value is rupees 10 each. So the face value will be rupees 4 lakhs. Then you have to less the capital profit, where you can get it from the control chart A. There's the 1 lakh 4,000. Then you have to less these two from the cost of investment held. So in this case, and since we are getting a minus sign, so this will be a capital reserve of rupees 4,000. Then the next working is the unrealized profit on stock. Now if you look at the third adjustment, it says stock of S Limited include goods purchased from H Limited for rupees 30,000 which were invoiced by H Limited at a profit of 25% on the invoice price. It means that in the stock of S Limited, there is a goods purchased from H Limited for rupees 30,000, which was invoiced by H Limited at a profit of 25% on the invoice price. So in this case, we have to find out the unrealized profit. So unrealized profit will be calculated in the following way. So you can see that we have assumed that invoice price is 100. So the profit is 25% on invoice price will come to 25. So the cost price will be 75, 75. So the unrealized profit on stock will be 30,000 into 25 divided by 100, we get 7,500. So after those working, we can prepare the consolidated balance sheet. So now if you look at the consolidated balance sheet, we have the various item. But before looking at these items, let us move on, or let us see at the note to the balance sheet. So before looking at the balance sheet, let us look at this note to the balance sheet. So the share capital they issued up, subscribe and paid up capital will be 1 lakh shares rupees 10 each. That is the share capital of H Limited, which is 10 lakhs. So the face value is 10 rupees each. So you'll have 1 lakh shares rupees 10 each. Then under the reserve and surplus, we have to take the general reserve of H Limited, which is 1 lakh. You can look this from, you can see this from the problem itself. Then we have the capital reserve where we'll find it from control chart B for rupees 4,000. Then we'll have the profit and loss account of H Limited, the opening balance, that is the profit and loss account on 1/1015 is 50,000 and profit for the year 60,000, so it'll come to 1,10,000. Then you add the revenue profit of H Limited. So this revenue profit of H Limited get from control chart A, which is 32,000, and from it we have to less the unrealized profit on stock for rupees 7,500 from working note number 4. So the total reserve and surplus will be 2,38,500. Then under the trade payable, you can see from the balance sheet, trade payables, we have two items, that is sundry creditors and bills payable. So these two items has to be consolidated. Now for these two items there is an adjustment. The adjustment says that bills receivable of H Limited include rupees 3,000 accepted by S Limited. So this will be known as mutual acceptance and will be adjusted in bills receivable and bills payable of the balance sheet. Then the second one says sundry debtors of H Limited include rupees 10,000 due from S Limited. So this is known as mutual owing, and this will be adjusted in sundry debtors and sundry creditors of the balance sheet. So now if you look at the third note to the balance sheet, that is trade payable, we have taken the sundry creditors of H Limited and S Limited from the balance sheet, that is 70,000 plus 50,000, that is 1,20,000. Then you have to less the mutual owing, that is 10,000, so you'll have 1,10,000. Then also bills payable of H Limited and S Limited from the balance sheet, 10,000 plus 5,000, you get 15,000. Then you less the mutual acceptance rupees 3,000, you get 12,000. So the total trade payable be 1,22,000. Then after which we'll have the tangible assets. So in the case of tangible assets, if you look from the balance sheet, we'll have land and building of H Limited and S Limited, which have to be consolidated. We'll get 3,50,000. Then plant and machinery of H Limited and S Limited will be have rupees 6 lakhs. So the total tangible assets will be 9,50,000. Then the next one is inventory. So we have taken a stock of H Limited and S Limited, will come to rupees 1,25,000. Then this unrealized profit has to be deducted from the stock. So unrealized profit is 7,500 from working note number 4. So inventories will be 1,70,500. Then also trade receivables. So we have taken sundry debtors of H Limited and S Limited, which will be 1,10,000. Then we have to less the mutual owing. As I've told you, the mutual owing will have to be deducted from both debtors and creditors. So on the asset side, it will be deducted from the debtors. So that's why mutual owing has to be deducted for rupees 10,000. We get rupees 1 lakh. Then after which we'll take the bills receivable of H Limited and S Limited, which is 15,000. Here also the same thing. We have to less the mutual acceptance. That is rupees 3,000. It will come to rupees 12,000. So the total trade payable will be 1 lakh 12,000. Then the last item will be cash and cash equivalent of both cash and bank of H Limited and S Limited, which will be 3 lakhs 15,000. So point to be noted here is that in case of mutual owing, it has to be deducted from sundry creditors and sundry debtors. In case of mutual acceptance, it has to be deducted from bills receivable and bills payable. And in the case of unrealized profit, it has to be deducted from the profit and loss account because it will reduce the profit, and also from the stock in the asset side. Now let us look at the balance sheet. So equity share capital is 10 lakhs, then reserve and surplus from node number 2, 2 lakhs 38,500. Minority interest is taken from control, chart A will be 1 lakh 34,000. Then the current liabilities, that is trade payable, that the node to balance sheet number 3, 1 lakh 22,000. So the total will be 14 lakhs 94,500. Then also for the case of tangible assets, node number 4 will have 9 lakh 20,000. Then inventories 1 lakh 17,500. Trade receivable 1 lakh 12,000. Cash and cash equivalent 3 lakhs 6,000. So the total will be 14 lakhs 94,500.